What's going on, Dividend Chasers? It's the Dividend Bloodhound here with another investing video. And in this video we are going to talk about my Trading 212 portfolio update. So without further ado, please give the like button a smash for the YouTube algorithm and subscribe if you've not been around here before for the YouTube algorithm. I'm certainly looking to grow my channel, so if you subscribe me and you want to grow your channel and would like a subscribe back, please let me know in the comment section below. Now into the portfolio review. So here we are. This is my sister portfolio to my larger Freetrade portfolio. So there isn't a great deal of money in here yet as I build it up over time. So I have £326 currently sat in my portfolio. I'm a little over 1% down, or 0.3%, and that's largely due to the after effects of the coronavirus effect on the market and the fact that my portfolio really isn't that well diversified just yet. So as we get into it, I have 3 shares of Altria Group worth £108. The price has dipped a little of late, currently leaving me £3.23 down, or 2.9% down. So the main effect on this group was the Trump administration deciding that they were going to regulate e-cigarettes, and e-cigarettes are now a large part of Altria's portfolio or product line. So although they've got plenty of other income coming from other places, they still get hit a little bit if they're going to regulate or ban e-cigarettes. Next up is and I bought that 1 share in Altria Group since our last update. Next up is the British Land Company, £32 worth of this company, equating to 5.6 shares, currently down £2.79, a little over 8%. A few balance sheet issues and Brexit uncertainty for this company, I believe, but should equal out in the long term, and I've got no problems or qualms with holding on to them for the long term. Next up we have Deutsche Lufthansa. I bought 2 shares in this company when I perceived that they were dipped before, and they've dipped a little bit further since, I would say. So let's have a look at it. Not by much really, 20p and 0.8%. and 10p a share really, so they're back roughly where I started, having gone up quite a bit. I would have made about £3 on these. They dipped back down, basically due to the ongoing issues that hit the whole of the aviation or airline industry as a whole. IAG shares were down as well, so was many other airlines. And the coronavirus again, I keep having to mention it, but you know, nobody's going to want to get a flight anywhere when there's the potential for getting infected with although it has a small chance, what could be a deadly virus. Now, it only seems to be China that's isolated at the moment by many airlines, but that could spread in the future, so we'll have to watch and see. Now, this could dip the share price a little bit further, which would then mean another buying opportunity for myself. Next up we have Iron Mountain. These are a very recent purchase, having bought them only a week ago. A very strong dividend paying stock. The debt this company has is a little bit of a concern, which is what throws investors sometimes. But their fundamentals seem relatively strong, apart from the debt burden, of course, and what they provide in IT services isn't going anywhere anytime soon. I'm actually currently sitting 65p up, or 0.8%. Next up, we have my very small Microsoft position that I just used when to essentially spend a tenner that I didn't really know what else to spend it on. And then when you look at that performance from Microsoft here, I mean, where else to stick your money where it's just market high after market high after market high. I mean, Microsoft is on fire right now and it's proving why it is a $1 trillion company. I'm at £1.48 in this company. I've only held it for a few weeks and my actual investment is only £12 to begin with. So very pleased with this one. I'll be looking to add more to it in the near future. Next up is the National Grid. Now this is a share that was added just today because somebody decided to use my referral link, which I will put in the comment section and the description for this video. If you want to bag yourself a free share worth up to £100 with Trading 212 and you want to start your investing account, click the link in the comments below and you can start your journey. You can get a share worth up to £100 and so do I as well, so we both benefit. Somebody used mine and I got £10 today, essentially £10. I got a share in National Grid, which I will keep for the short term, I think, and then maybe sell in the near future and probably put that money back into somewhere like Microsoft or a dividend paying stock. And then last but not least, we have Occidental Petroleum. So these have suffered some balance sheet issues from the start of the 2019 onwards, but their yield is massively impressive now because of the cheap share price. And I bought in at a relatively low position, in for 2 shares and £64.40p, and I'm actually £2.70 up at the moment, or 4%. These guys have an extremely strong yield as well, so I'll be looking to add more to this position as time goes on. And then we'll move down here to the allocations. So as you can see, my portfolio looks sort of diverse, but is very heavily weighted towards Altria and Iron Mountain. And as it's only almost plays second fiddle to my Freetrade account, it's only like small bits of money that get deposited here. So I have to be careful with how much I actually earn. But I do plan, there's a little cheeky goal for myself, I do plan on trying to have this portfolio over £1,000 in value by the end of the year. So let's try for that one. And now, just a quick rundown. I'm not going to do any analysis or anything like that. This is just quickly my watch list for the future, and when I get a spare little bit of money that doesn't automatically seem to make it into Freetrade, some of it might make it to here. So number one, we have a ETF in the Brazilian economy. The Brazilian economy is getting stronger and stronger, although that doesn't look like it, to be fair. The Brazilian economy is due to be one of the biggest growing economies over the next 20 to 50 years. So you would expect that the ETF attached to their stock market will grow as well. I'm going to keep an eye on that one. We've got Public Storage in the US. It's been a good dividend payer and is due to grow over time as well. We have Brookfield Property Partners. They're a good dividend payer as well. We have Enbridge and Ventas, Enterprise Products Partners. All of these are quite chunky dividend yielding stocks. The Pembina Pipeline again, all quite chunky dividend paying stocks, and this is where I plan to get my high dividend. There might be a little bit more risk in this, but high dividend paying stocks to really make the most out of my money that is invested here. And then Energy Growth, another 4 to 5% yield in stock with some good growth potential too. And then we get more into the Canopy Growth, which is going to be, hopefully, if cannabis goes where most people think it's going to go, this stock will continue to go skywards. I mean, it went to the moon there really, but a consistent growth over time would be good. I mean, it's already up 604% in a little over 6 years, so I hope it could do the same if I bought a couple of shares, do the same in the next 6 or better. Airbus is next on my list purely because I own Boeing on the other side in Freetrade. I just like the thought of owning the duopoly, or owning part, a very small part admittedly, part of the duopoly that basically sell planes to every major airline company in the world. So Boeing is doing less well at the moment, which is hence why I bought the 2 or 3 shares in it that I've got. And Airbus is benefiting from that, so it's got an uptick in its orders in the short term. And these two kind of trade blows to each other, but nobody can ever trade a knockout blow, because I don't think Airbus could absorb Boeing's custom, and likewise I don't think Boeing, even though it is the biggest and largest airplane manufacturer in the world, I don't think it could absorb Airbus's order book either, which it won't have to, because they're both pretty strong companies. Just Boeing is having a bad time of it at the moment due to the Air Max issues, the 737 Max issues. Next we have a dividend king, Stanley Black & Decker. Doesn't appear in Freetrade, so I'll have to buy it on here. Love the thought of owning this stock, even though it is at an all-time high at the moment, or very near to it. I will get hold of this stock in the future. It has a yield of about 2.5%. Then further down here we have Mercedes, no real introduction needed. Luxury car manufacturer, the go-to for many premium car buyers, and also looking to go electric, and will eventually probably be somebody that will try and steal some of Tesla's market share back off them. Now, Tesla has got a iron grip on the market there at the moment, but I would expect that over time this will be loosened slightly as the big premium German cars start to get back into it and steal back a few electric car buyers from Tesla to the likes of German premium cars such as your Volkswagen, your BMW and Mercedes. Got BMO Real Estate here, a monthly dividend payer, something to get into to get a monthly income into your portfolio, and as it's so cheap you can drip into it quite easily. Macy's is a very high dividend payer, so just keeping an eye on them because I'm hoping to have a really high yield portfolio. Royal Caribbean I've watched because I noticed that Carnival on Freetrade decided that the investors decided they were going to jump out of it because of the coronavirus. But looks like Royal Caribbean's held up a lot better and hasn't lost too much of its share price at all, really. I will continue to follow this one though, just in case a better buy opportunity comes along. Yeah, $10 I suppose. 20. Yeah, could be a buy. Next we have Genuine Parts, and yet another dividend king. Been paying dividends for years. Not available on Freetrade, but available on here, and it's just part of the collection. A safe, or safer should I say, dividend paying stock, and is expected to not go anywhere and continue to grow over the coming 10 years. James Smucker, just about to become a dividend aristocrat, or dividend king, sorry, that my memory lapses there, but they are on the cusp of doing one or the other. Either way, it proves that they're a very solid company and will continue to do so in the longer term. I can't wait to get hold of these. I love Smucker's food when I'm in America. Can't really import it over to the UK so easily. But yes, what I can do is 100% buy a share, so I will. Beyond Meat is next on there. This is just purely there for growth potential, But I noticed it got pumped and dumped, a bit like I think will happen to Tesla at the moment. So it went right up to $220 and then straight down to 78. Not that that's I'm not knocking Tesla there. I don't want people to come screaming into the comments going, "Oh, look how amazing Tesla is." I do appreciate Tesla's innovation and its owner or CEO, Elon Musk. I just think that the market is going absolutely wild for this stock at the moment. And while 260, 270 was probably an undervaluation, I certainly think that 800 or 900 or $1,000 is certainly an over-evaluation and just a bandwagon and a hype wagon for the time being. I mean, it's got there so quickly, it's just ridiculous. When these analyst companies decide to update a stock, it goes over, I'll just type it in there, it's supposed to go over and grow over the coming months. Not so a price target of 1,000 a year. Oh, there we go. Look, I've already been proved semi-right. So, yeah, basically, that the share price is supposed to get there over the next 12 months. It's not supposed to smash through it within a week. And that seems to be what's happened here. So it went screaming along. Everybody's pumped it up. And it got to 961, and then just on the cusp of when people were like, "Oh, Tesla, $1,000, $1,200, what's happened?" Buff, straight down to 760, 750 at one stage, and then I genuinely think this might even cause an even bigger sell-off when people decide to really bottle it and dump their shares quite quickly, especially if they've made profits already. They're going to get out. If you've bought in now too late, at 800 or whatever, you got no choice but to hold. But anybody that bought in at 700 or less might just decide to take it, and that could cause the share price to sink even more. I feel sorry for anybody that's been caught in that. That's quite a big window. It's quite a big window to get caught out in there, to be fair, in the space of, well, a few hours. Right, anyway, back to what I was doing. So, next on there is another cannabis stock. We've already talked about that, won't talk too much more about that. Reality Income, this is just a staple, absolute staple, at an all-time high, so I don't think I'll be buying too soon, but it is a monthly income stock, and everybody wants hold of a monthly income stock at some stage. So I will be jumping in at any time this company takes a dip. Intuit, the IT company, just continues to absolutely smash its growth. Doesn't pay much of a dividend, but it just absolutely outstanding growth. Might be worth jumping in on this one to see over the long term, to see how it goes. I wouldn't rule out jumping into Tesla while I'm here talking about it. I just think fair value for them at the moment now is about $500 or $600 a share. And if it goes down there again, I could be talked into it, and I could consider it. But anything more than that, nah, it's way too high. And we got Target, the miracle stock, as a lot of people call it, still going strong after all these years, and at an all-time high. Waste Management, Kellogg's first, just, staple, breakfast, breakfast club. You need this stock. It's paid dividends for a very long time, so it automatically, being an aristocrat that it is, it automatically gets onto my watch list because of that. Waste Management, also very similar, and with how environmentally conscious the world's becoming, this is only going to become more and more prevalent over time. And just look at that growth, absolutely perfect to be watched and researched into. Southern Energy, United States is always going to need its energy from somewhere, so why not own the supply? And again, it just continues to grow and grow. And coming in at the bottom here, we have IAG, who obviously own British Airways, just beginning to creep back up now because of the perceived end to the coronavirus. There's been talk of a vaccine, so the markets have obviously sort of reacted to that and starting to view the end of the crisis, so people will start flying. British Airways did have isolated themselves from China, so they're not flying any flights into China anymore, so this will hit them in the pocket a little bit, but probably not significant enough to cause any major damage to the balance sheet overall. TUI is doing just fine as well. You need to own part of the holiday industry at some point. They're down overall, so it is probably a decent time to get in there. And this is all down to uncertainty over coronavirus and Brexit and the German economy as a whole, to be fair, and the EU's economy. Babcock and BAE Systems, both big defence companies here in the UK. Babcock's pretty heavily down at the moment over all time, but they've won some pretty big contracts from the Royal Navy recently to help build the Type 31 frigate, which they're going to build 5 of, potentially more, and there's going to be an export variant, and they also look after the UK's submarines, so there's plenty of money wrapped up in Babcock for a long time to come. And that's pretty much mirror images with BAE Systems, although their stock chart looks in a lot better shape than Babcock's. They certainly are very, very well integrated with the US Navy, the Australian Navy, and military as a whole, the US military and the Canadian military. The BAE Systems have sold the designs for the Type 26 to Australia and Canada and the UK, so they've got a very big money stream coming over the next few years. Baguette & Platt, another dividend king, so automatically makes to a watch list. Again, can't get it on Freetrade, so I'm just watching it on here instead, and that'll make its way into the portfolio when I've done a little bit more research into it. But if it's been around for 25 to 50 years and it's been rising its dividend for that long, that in itself is more than enough reason to get it on the watch list and maybe even into a portfolio. Virgin Galactic is next. This company's got huge potential as space travel actually becomes a thing. I mean, it still isn't at the moment, but the potential is slowly building. I looked at this stock at somewhere around this point at the $9 mark last year. And they can see it's doubled in that time. I ruled it out because it's still pretty unfounded. It would be a growth stock, but I've jumped it in there, and I can't see why it wouldn't be now. I can't see why I didn't just chuck £10 at it and just see what happens, or maybe more, because I'd have doubled my money. Hindsight's a wonderful thing. I didn't think it would take off, pardon the pun, as quick as it did. Siemens next. I think these guys are going to have a big role in building HS2 trains and HS2 as a whole, and the infrastructure in the UK over the next 30 or 40 years as a whole. As even though the UK has left the EU, the Siemens retains a pretty big factory footprint in the UK, and obviously the EU, so the UK will continue to probably buy its trains from them. So I'll be keeping a watch on this, and hopefully I can benefit from this HS2 contract that will. HS2 is actually going to be formally approved by the look of it. It's been sort of muted by the government that they're going to approve it, like a little bit begrudgingly, because it needs better management. But they've all but the Chancellor's approved it. The report actually commissioned into it suggests building it just with some reforms, a renaming of part of the line to make it more palatable, and better management of the 106 billion. Yeah, that's right, 106 billion that they're going to spend on it. And while I'm talking about that, both